Crisis hedge is also known as safe haven. In other words, if a crisis, financial, monetary, currency crisis strikes, you'd better be in gold. You don't want to hold the currency, you don't want to hold stocks, and you don't want to hold bonds. Government bonds may be okay, but government bonds are never denominated in gold. Government bonds are denominated in some currency, and even if you get your full principal with the interest in whatever currency, the currency itself will devalue. So, if you got a crisis, you'd better be in gold as nothing else holds. Not even real estate, okay? So, this is called safe haven investing, and especially for the last 8 or 9 months, since August 9th, you have very clearly seen that as the financial crisis has, been developing further and further, gold has been rising up and rising steadily against all world paper currencies. Now, there has been also some understanding that there is that other alternative asset called gold as opposed to bonds and property, real estate. In other words, for the last 20-25 years, people have been conditioned by financial media that you invest in stocks, bonds, in real estate, and that's it. There's nothing else to invest in. Well, now people realize that bonds are a terrible investment because inflation eats away its, purchasing power. Stocks aren't going much or anywhere, and especially now people see that stock markets aren't performing globally anywhere well, and suddenly, now that the real estate bubbles have begun to burst, certainly in the US, certainly in Ireland, certainly in the UK, in Spain, now it's bursting with Estonia, right, beginning. So suddenly people realize that real estate is not as safe as they thought 3, 5, or 8 years ago. So when you look around, what else is left? Well, what else is left is commodities and gold. There's nothing else left. So alternative assets has been driving demand for gold. Now, there has been so far a central bank price suppression, gold price. In other words, central banks don't want to see the price of gold rising. Why? Price of gold is a barometer. It's like a thermometer telling you that if the price of gold is going up, something is somewhere fundamentally wrong and unsound with either the financial system or the banking system or the currency, monetary system. Somewhere there are problems. Usually these problems are interconnected. Usually the problems are in all three, financial, banking, and monetary system. So central banks don't want to see gold price rising because it tells people something's got to be wrong somewhere. People sometimes see the price of gold, something must not be right. So central banks have been suppressing the gold market for a while, which has been great for investors. Why? Because central banks were selling gold and investors were buying a lot cheaper than otherwise the market will be. Well, guess what? Central banks are beginning to run out of gold now. I mean, they sold half of their gold already over the last 5 years, and they say, well, we can't sell any more. We don't have it. I mean, just dump it all. So suddenly central banks have begun, that's the next point that I have here, end their gold sales, as it doesn't make any more sense to sell it, especially as the price is rising. And as, for example, the UK sold its gold at right at the bottom, $250. And I say, well, wait a minute, you guys sold our gold for $255 and now it's $1,000. You guys lost us quite a few billion pounds or quite a billion dollars. So suddenly there is a pressure for central banks not to sell gold because that is stupid, because gold prices are rising. And finally, turns out that while some central banks are relatively dumb to sell their gold at dirt cheap prices, some other central banks are actually smart and say, oh, we'll take it. So Russians aren't hesitating, they're buying. Qatar or Qatar, however you pronounce it, the central bank has been buying. And reputedly, the Chinese central bank has been buying. The Chinese have $1.5 trillion. They're trying to figure out how to spend them, in other words, how to diversify them. And one of the better investments for the Chinese central bank is buying gold. Of course, they can't come officially to buy gold. So, reputedly, through Australian and a number of Hong Kong and other Singaporean hedge funds and investment funds and all sorts of other third parties that cannot be linked to the Chinese central bank, the Chinese were buying and are still buying their cheap gold. So the point of this fundamental analysis is that there have been almost a dozen of drivers, all of them pushing steady buying of gold. But more importantly, you'll see that all of these are not only have been valid, but will be certainly valid for the next 3, 5, and possibly more years. That will continue to demand for gold higher.
You don't need to be afraid for any political interference in this from the
well, political interference actually helps the price of gold.
Exactly, because everyone knows the price of gold is stable more or less.
Yes, well, it's not the price of gold. That's the correct statement is the value of gold and the purchasing power. Because when you say the price of gold, you must say price in terms of what? Is it euro or is it oil or is it cookie bars, right? So the value of gold, everybody understands, is remarkably stable. So rising price in euro or dollars simply says that the value of the euro is falling or the dollar is falling. Now, there has been more, I'm zooming in now on that one bullet, which was safe haven demand. Well, what has been driving investor fears? Well, investor fears have been driven by falling dollars, which has driven some other currencies to be weak. General currency market volatility. If you have noticed over the last 2, 3, maybe 4 years, overall currency volatility, one currency against another currency, has been rising. I mean, you see gyrating yen against the dollar and, of course, against the euro. You see wide fluctuations in the British pound again. So, you are seeing dramatic fluctuations in both directions, and that increases overall currency risk. And then, if you're facing overall currency risk, you just move on and get some gold. You know, at least you get a stable value. Even if the price is varying, you still get a stable value. Financial market instability. You all know about, if you're here, you got to know about the credit crunch and all the problems. Now, potential bank bankruptcy. I mean, what is it? 2, 3 German banks are in deep trouble. They had to be saved once and a second time and a third time. Everybody knows Northern Rock, right? In deep troubles. The British government gave them $1 billion to save them. Wasn't enough. 2 more billion, not enough. 3 more, 5 more, 10 more, 20 more. And now the total is gone to up to 70 billion so far. And still not enough to feed that monster. All right, well, how many like Northern Rock? God knows. The point is that if you're going to be having bank bankruptcies and the banking system is unstable, you'd better be out of the banking system and you'd better not have assets which may be negatively affected if the banking system begins to unravel. Of course, this is the point that you made. There are some political fears and, of course, political interferences. And political fears sometimes may be something like, well, let's nuke the hell out of Iran. I mean, see, let's just bone the hell out of them. Again, so we are talking about political also. The next one, war fears. That there may be some wars here and there. And also economic recessionary fears. Finally, it begins to sink in the United States that the U.S. economy is in recession. And this means deep trouble for the banks because borrowers can't be paying back. Now it seems that corporations are going to be in deep, deep trouble. Their corporate loans. There's a big junk bond market. So suddenly recession fears begin to say, oh, if the economy spins in recession, the financial and the banking system is going to be in much deeper trouble than we originally thought. Well, guess what? The Eurozone was believed to be growing roughly like 3%. That was the forecast for the Eurozone in December and January. Well, they've already revised it by, what is it, roughly half a point so far in 3 months. That's not enough. Over time, meaning over the next 2 or 3 months, the Eurozone and ECB and whatnot will realize that the Eurozone economy is so much weaker, of course, because of the credit crunch, and you will get some recessionary fears for 2009. And then again, begins to fade. So, overall uncertainty in the world. Well, the world has just become a lot more uncertain than 5, 10, or 20 years ago. So all of these fears drive safe haven. Safe haven simply means if you're afraid of bad things happening, where are you going to put your money? And the answer for at least a couple of thousand years has been one, gold. All right? So, what is it? Sovereign wealth funds. Well, these are the central bank of, let's say, Qatar or China or other oil exporting countries or Japan or whatnot. They got hundreds of billions of dollars and they got to put them somewhere. Well, if you're Saudi Arabia Monetary Authority and have $200 billion, you cannot invest in oil. It's plain dumb, right? You got to put it somewhere else. Well, what else can you put it if you're Saudi Arabia pumping oil? I mean, if you're some other country like China, you can put in, let's say, 50, 100, or 500 billion in oil. That's okay. China could be buying lots of oil. But all the oil exporting countries will be playing dumb to be buying and investing in oil. They got little other alternative. Well, they can buy a company here and a company there. But ultimately, gold is the choice. Again, it has been for a couple of thousand years, and it is now. And finally, institutional investors, I mentioned it already, it has become mainstream. They are beginning to no longer be afraid that gold is a risky investment. Now in 2008 is considered to be acceptable. So this is driving investment demand. Well, here is what the picture looks like. There has been a little off in 2006, but you can see these are million ounces. It's noted down there, million ounces. This is what investors have been buying. And you can see steady increase up until 2005. 2006 has been fairly weak. There's been some explanations. I don't want to get into that. You can also be getting probably that PowerPoint on the website too, so anybody will be able to download it. Well, other demand has been consumer demand. There's been rising jewelry consumer demand. Well, we were discussing this today, mostly in Middle East, India, and Pakistan. Not because they're eager to pay twice the price for their jewelry, but because for these countries, jewelry demand is a quasi investment. So when they consider jewelry kind of like an investment. So they've been buying a whole lot more, even at steadily rising prices. And finally, there has been rising in industrial demand. It is associated with rising fabrication costs. I mean, here and there, you got to put in a little bit of gold because gold's got nice, beautiful properties, good conductivity, it doesn't rust, and all this kind of stuff. You have some military and high reliability equipment. You'd better have it with a little bit of gold plating. Of course, it takes less than 1,000th of an ounce, but you make, let's say, 5 million pieces, and suddenly, you know, the quantity keeps building up. And it's been used massively in all sorts of electronics, including GSMs and mobiles. Again, tiny quantity, but, you know, take 100 million Chinese, you know, wearing a mobile, and then see gold that will, you know, demand. All right, let's see what else. Gold investors now own more gold than central banks. Well, central banks have been selling and selling and selling. Gold price has been extremely low and so cheap that investors had no problem buying and buying and buying to the point where now they own more than central banks. So again, if already investors hold it, here's another thing. Gold investors seldom, if ever, sell their gold holdings. So gold investors are very long-term buy and hold oriented. So once they have bought it, they'll hold it for 10, 20, 50 years and they'll try to pass it on to generation and generation. My dad just gave me, oh well, it was just a year ago, gave me a nice gold coin, it's American dollars from says, hey, I got this from your grandfather, and my father's now 72, and I'm probably not going to use it, so here it is to you. So we've held this gold coin for 80 years, and at least for now, I don't have any plans to sell that particular, well, these particular gold coins. So extremely long-term oriented, usually generational investors. Well, what the first one is saying is that if now investors already own more than half of the gold, then very little, only less than half is available on the market, and it will be available, of course, at much higher prices. All right? So, again, another very interesting statistic which I found very revealing was that only 1 or 2% of all people's liquid assets are now invested in gold. In other words, out of every million, you have probably, 1,000, 10,000 invested in gold. All the other money is not in gold. In other words, you still have 98%, which is not invested in gold, and all that you would need is probably another 2 or 4% to move into gold. So rising from 1% to 5% will easily drive the price of gold from roughly 900 to 3,000. God knows, maybe 5 or maybe 10. All right, so very little is needed to shift from other assets to drive the price of gold sky high. All right, any questions so far? Let me see what I have. All right, so this is the part 2 fundamental analysis. Questions? Yes?
The IMF, the International Monetary Fund, recently announced that it would sell 12% of their gold.
Again, yes, we were discussing this. They have been announcing over and over and over. I'm telling this to my students because, you know, they're 19, 20 years old. And I'm saying, look, you're a big seller of something. And you got to unload it and get a good price. Are you going to tell the whole world we're going to be selling 5 tons of whatever? You know, this will definitely suppress the price substantially, and you're going to be selling at a substantially lower price. I mean, you see, think of it. Warren Buffett decides to sell his whatever position, Coca-Cola position, and announces to the whole world, I'm going to be selling my Coca-Cola. Well, what's going to be the result? Coca-Cola price is going to collapse. He's going to sell and then it's going to rise back up. I mean, no smart investor ever announces that he will be selling a significant position. That's plain dumb. Of course, it's even dumber to announce that you're going to be buying a large position, because what's going to happen? Everyone's going to buy before you, and then they're going to unload it onto you to a large profit, and you're going to be paying a lot higher price. It doesn't work like that. So, again, these have the idea of scaring the gold market and scaring weak investors or speculators. Say, well, let me get the hell out of it before they start selling. And what is important to understand is for the last 7 years, they have been announcing 15 gold sales. Gold market usually moves down for a couple of days and then recovers back in a week or two. All forgotten. It is a non-event. It has, well, it reacts for 2 days and then a week later it's forgotten. And then it moves on and then they make another announcement. They have kept announcing this over and over again with no significant intermediate effect. Yes, short term always, but intermediate term, it doesn't matter. Plus, it turns out that they're talking about tons, but in the end, it's still a drop in the bucket. All right? So it is not even, we were discussing this, I mean, that's on the internet, and I read a lot of articles about it. Any other stuff before we move on to portfolio? Okay.
What do you think about the correlation between silver and gold?
Very strong. I'm quite an expert in silver. Just please don't get me started on silver. Yes, very strong correlation, close to 0.9. Silver is as good as gold, in many ways a lot better. It has its major advantages over gold. It has its own disadvantages too. I mean, you can't just get 200 of silver and, you know, move it over and, you know, ship, unship, load, unload, and store and all these. So it has some inconveniences, but silver has a slightly better potential. But Europe, EU VAT is a distinct problem. VAT tax kills silver and silver investments. So it's a lot trickier. It's a lot better investment in a non-taxable environment. But I don't want to get into that. That should be another meeting altogether. Let's try some other questions. Somebody had a question there? Yeah.
Yeah, I was thinking in 2005-06, I was doing research into gold on the internet.
Okay.
Most of the gold miners said, we're not mining, we're not even going to put a spade in the ground to dig up gold because it's too cheap.
Back then, yes.
Yeah. That was also a cause of worry into the currency markets at the time.
Are you guys giving them the microphone so that they're heard and better recorded? All right, let's apologize, but we should have been using this. All right, go ahead.
In 2005-06, a lot of the gold miners decided not to dig for gold because it was too cheap.
At that time, yes.
Not cost effective, causing a squeeze then on the international currency market because of speculation. And the improved economical factors in China, India and other countries, and the demand for consumables was pushing up the price.
The price of what?
Of gold.
Okay.
Would you say that that will further increase the increased demand, the increased buying power of these nations?
Of which nations? China?
China, India.
Yeah, but...
Would you say, now the gold has gone up 110%.
Okay.
Would you say that it will push it further, like another 100%, even though you say the factor of 15?
Okay, the answer is yes, but they are able to buy gold because they are producing, they are exporting, they're generating revenue, and they're a prospering country. They do all of these cameras, these laptops. So they produce, they generate something, they generate value, they sell it on international markets. They get currency, which the Chinese at least understand well is losing value. Now, just recently, the big news was that about 3 months ago that the Chinese government has authorized and encouraged the retail investor, just like, well, some of you or many of you, walk in and actually buy themselves a gold coin. You know, and you got some money, get a 1 ounce or half ounce, as much as you can. So there has been a phenomenal increase over the last 3, 4, 5 months in China from retail ordinary people who have a little bit of savings. The answer is yes, they're getting a whole lot richer because they are producing and they are exporting. So they will be a significant force in the future. Is that answering question or not?
Yeah, no, I lost my train of thought, but yeah.
Yeah, well, you began with the miners. They weren't mining because back then gold was like $500. So all they were doing is poking holes and trying to find, if there is any, how much it is it economical, and at what price it will be economical. They poke a hole, they say, oh, there's that much of a gold. It's going to be economical at 650. All right, now it's 500. When it becomes 800 or 900, it will be economical. We'll mine then, not now. Let's keep poking holes and still find what else we got on our properties. Is this kind of... All right.
But of course, there is always a limit. no, let's say we talk about oil.
Mm-hmm.
Then in order to keep the prices, let's say, they control how much oil do we drill from the ground. Now for gold, of course, I do not know how much gold we can find in the world today.
Not a lot. I mean, find and dig it out of the ground?
I mean, because then you could also, in that way, if prices are going sky high, you could dig more.
Okay, well, here is the answer. I made here a tricky assumption, which probably I had to explain is, all I was doing was demand, and never said a word about supply. Here is why. Supply of gold has been accumulated over a couple of thousand years. Very little of the gold that has been once mined has ever disappeared. So you have accumulated gold over, let's say, thousands of years, and one annual production of gold adds no more than 1% of the overall supply. If you really double this annual production, which is next to impossible, you will increase the gold supply not with 1%, but with 2%. So, differently stated, the current annual gold mining, which adds to overall supply, is a tiny drop in the bucket that cannot in any possible way affect the gold market. So, is that beginning to answer? Let's see, someone else had a question, and then we see how much time we have, because I still have 3 more types of different analysis to cover.
I think that if participants, Professor, we can go over time. What do you think?
Yes.
Okay, you have extra.
I have no problem as long as these guys find it entertaining and educational. It is, you know, the name of the game is called edutainment. It's got to be education and entertaining. That's what I've learned when I'm teaching students. I mean, so what's the question?
Yeah, my question is, recently, I believe is Professor Antal Fetke.
Antal Fekete, yes, I know him well. I read him and study him, yes.
You mentioned, as you mentioned in the last slide, that the accumulation of gold usually is a forewarning of a freeze in the economic system. Can you comment on that, please?
Yes, indeed. That's the safe haven. That's the crisis hedge. So usually when people sense that something's fundamentally wrong, of course, it doesn't mean when smart people sense it today that the system crashes tomorrow. Usually it needs to build up, just like the credit crunch in the US. A lot of people were sensing it in 2005 and 2006. Moreover, the system froze once in February, unlocked, and up until August, everything was fine. And the answer is yes, a lot of people, investments and savvy investors, feel and can see that there are problems down the road, 1 or 2 years down the road. So they are buying in advance. Well, that's the smart money buying for a safe haven. So yes, that's what it is. At least I am buying gold in expectation that the banking system and, of course, currencies are going to be having trouble, and a lot of people do so. So the answer is certainly this is true. Essentially, when people start moving massively to gold, that's an indication that at least smart money and big, at least, institutions believe that there are some fundamental problems in the system that will be exacerbating over time. Answering? More questions, or I move on? Of course, when I'm done, you guys will still have opportunities to answer. I mean, at your disposal all evening long. All right, let's see portfolio analysis.